Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, November 16th, 2023. It is 3:03 p.m. Eastern Time as I'm starting the video, so we have about an hour to go in the trading day. However, this one is not time sensitive, so it'll probably get out to you shortly after the close, I would suspect. I'm just going to kind of throw in, I usually try to keep the videos concentrated on one or more related topics. I'm going to throw out a couple trade ideas. This one you could take, so I'm throwing it out in the front, but I have a benefit of the doubt trend line. I had a price alert trigger today on TJX. Might have been in earnings. I think they were reporting. Either way, and I can probably extend that divergence line. One that I've been watching for a while. Again, I haven't really watched it until today. I had it marked. I'm sorry. I was watching it not day by day, but the alert fired off today. The alert was on this trend line. If you can see my chart here, I have a primary uptrend line. That's my preferred trend line. And just today, I added the secondary parallel, what I call BOD or benefit of the doubt trend line. Why is that there? Because I have 1, 2, 3 reactions here. I'll draw it on a clean board, and then you can see it. You have a couple of candles. If you draw that down right here, there's the BOD trend line. You create a parallel trend line. There's my primary trend line. The primary has more reactions, so that's the one I think is most important. So I think this breakdown will stick. But like I said, if you want to give it the benefit of the doubt, that's what I call it. You wait for the second of the two, because this one has 1, 2, and now potentially 3 reactions if it gets a little bounce here. But it has taken out the primary trend line today on a pretty solid red candle. And again, you can see on the main board you've been building divergence on this one. Basically, it's just a big old fat bearish rising wedge pattern. You had a sell signal here recently, initial sell signal, and this is a second sell signal. And my targets, sorry, I didn't have them marked up for you. Let's just say if it sticks, bump me if you're in it. If you take it, minimum target 82, 80-ish right there. Plus you have the 200 days coming in just above that as well. So you're talking still a good, at least 4 or 5% to the minimum to the first target. I'm not getting too excited about anything today. Today's a flat day. That's why I haven't gotten really much out to you. It's just market's going nowhere. It's literally flat right now as I do this video. So it's, been bouncing between slightly positive and negative territory. So here's what I'm going to cover in the video. Other than this one and a couple other trade ideas I'm going to start with, I want to cover some charts and developments that I believe are very important, things to watch, and not only where I think the market's going, but where I could see it going if wrong. So I'm going to start after I give you a couple quick trade ideas like this one. I'm going to lay out the bullish scenario, and then I'm going to follow up with the rest of the video as to why I don't think that's going to be the scenario that plays out, but how it may certainly well be, and I don't want to miss out on too much of that. I will tell you, right now I still maintain a longer term to intermediate term bearish bias. Very near term, I made the case, which I'm still stand by. That I think it's a very good. I'm pretty aggressively short the indexes. Haven't gone anywhere yet, but the same 60-minute divergences I pointed out to you the other day. But I'm going to go over some charts I haven't with you yet, and some of those will be market breadth. I'm going to go a little bit deeper into that. Those are the internals. I covered some charts on the NASDAQ yesterday. I have a few more that I think are very compelling. I want to share that with you. And really just focus on that. The market internals, key technical levels, the top companies in the NASDAQ 100 and S&P 500, or i.e. the Mag 7. And then I also want to just highlight the bottom tier of the NASDAQ 100, and that'll illustrate 2 points I'm going to make in this video. One being bullish, one being bearish. So you'll see what I'm talking about in a second. And then bonds. Bonds. So let me just start out. Let me get these trade ideas out of the way. There it is, TJ Maxx. If it takes out the BOD benefit of the doubt trend line, and I see some minor price support right about where we're at, 87. So really much below 87 should do the trick. And a lot of these, if I look then at the weekly charts like I'm doing right now, I can make an even longer term bearish case that this stock will fall a lot further. So right now I'm not taking that one at this point in time. I may decide to jump in tomorrow, next week. I'm going to get to that in a second, particularly Nvidia coming up. I want to talk on that. One other one, trade idea, and it's also a short. Intel. If you've followed me for a while, you remember back when I was short, bearish the markets, and even the semis. There was one semi that bucked the trend. I said this one clearly has a bullish chart. It was my favorite. We traded it long, only long. Well, no, I take that back. We longed it here, bounced it long again, and we even shorted a pullback, at least one pullback. I remember having several trades there, all posted on the site, gaming this trading range. In last going here, this is where it really set up nice. Big positive divergence. Remember, Intel didn't look like the rest of the semis. Typically birds of a feather flock together in this sector, but Intel had its own things going on for a while. You can see it's really kind of stalled out a long time ago. It peaked back here in 2020, right before COVID even hit, and it never even saw that high again. It came close here in 2021, early 2021, before the NASDAQ peaked. But you can see my chart. And again, you can remember me covering this one. It's now come, this was a major support zone. I created that way back, in 2020, telling you that was a major support zone. And we hit it. Then we hit it again, TA 101, buy support if you think you're going to bounce, or if you're just market agnostic, you don't have a bullish or bearish opinion, you just want to trade mechanically, you buy pullbacks to support with a stop below, or you short a break of support. We hit it again, and then finally it gave way right there. And, again, you can see I labeled that major support 2020. Haven't changed that annotation since then. And that goes to show when major support is broken, you don't just have a little 3% pullback, 10% correction. The bottom falls out. And that's what happened to Intel. From that point, had you shorted it, the stock still had another 43% drop below there. And that from the highs, that's this stock. Again, this used to be the big dog in the semi sector, and it's long since lost that title. But all right, that was then, this is now. So we put in that divergent low, very bullish, and then went on after gaming, some swing trades in here. We popped the trading range here. We had one move back in it, and that was kind of a shakeout move. But then when we finally took it out, it's been nothing but an uptrend really since that divergent low that was pointed out back there. Wish I could tell you I sat there and milked the whole thing, and I didn't. I had few good trades, but what I can tell you, and you haven't heard me cover Intel much lately, and since then until today. Remember that major resistance zone? What do I always say in trading? It's technical analysis 101. Support, once broken, becomes resistance. That's the level right there. It's a big resistance level. It's so big a blind man can see it. So no guarantees that you can't stop, go right through there. But that coupled with the fact we have negative divergence, the same reason back here I was bullish with the positive divergence. You've come full circle with negative divergence at support. Yes, blah, blah, blah. I know they're one of the big beneficiaries of Biden's big CHIP Act that they passed. I understand that. But again, ask yourself how much of the 75% rally so far this year has priced that in. So there it is. Take it, don't take it. I can't make a screaming case on the 60-minute. We don't have divergence. We're very overbought. But again, on that daily and even weekly chart, so if you're willing to give this one some room, coupled with the fact I'm also short and looking to get back into the semis. If you remember, covered our semi or mine and on the site, told you right here when T2 was hit, I'm covering shorts, going long, reversing because we had positive divergence and a beautiful little bullish falling wedge, divergent low, broke out, and semis them now, in my opinion, like the NASDAQ 100, most likely come full circle, and they have my beloved negative divergence. Same reason I was bullish at the lows with the positive divergence, but in reverse. Negative divergence is bearish. And so why I'm doing this also is, again, Birds of a feather typically flock together. Intel wasn't flocking with the rest of the birds or flock for a little while there, but lately they have been. I'm going to add right here another level. I have different boards on SOX, but you can see SOX right here. See that major reaction high right there? Well, that's where we're at right now, about 515. SOX is one of three major semiconductor ETFs. They all have just different weightings and different holdings within the sector. But there it is. Rally back into resistance. And if this is a bear market, which I'm going to give you some evidence here in a second that it might be, there's one for you. So the SOX, Intel, and by the way, guys, two trading strategies on it. Either the quick pullback trade. Okay, Randy, I see you're right. Semis, they've had a heck of a run, but I disagree. I think the market's going to new high. I think we're in a bull market. And so if that's your mindset, maybe you just want to take the quick buck. I'll have to sharpen my pencils. I don't have it here. I'm going to have to retask this target, retask my price targets, resequence them, or put new targets, really. So it's pretty much covered there. And I will do that. But there's a big old gap. And, just like the NASDAQ 100, remember QQQ, it's no coincidence. You have the same downtrend line off the July highs. That's certainly a logical or ideal target right there if you're looking for a swing target. So that's SOX, Intel. Obviously, you can have overlap. Keep that in mind. When if you're shorting or going long a semiconductor ETF, any individual semis, you're just overlapping. So, and that's fine too. I'll quite often do that. I'll overlap or some of my sector trades with the most bullish or bearish charts, stocks, individual stocks within there. Or sometimes I'll even take, like with Intel, for example, as a hedge, when it's bullish and the rest of the sector looks bearish, that's an indirect hedge. I'll do that as well. All right, one more for you. No, that's it. I wanted to throw those out. But yeah, let's segue into the new king. Like I said, Intel has long since been dethroned, at least a couple of years ago. It seems like forever now, but it wasn't just so long ago that it was a bigger company. And then this guy came along, NVIDIA, originally, just making, from best of my knowledge, making video cards for gamers. I had a teenage son who's off at college now. He was all into that, so he was always talking to, of course, because he wanted me to whip out the credit card and buy the latest and greatest card. And then, he, like a lot of kids and, people got the itch to mine crypto. He wanted to turn a whole bedroom into a crypto mining facility, which was a hard no for me. Anyways, but where I'm going with that is, so, NVIDIA kind of, started out with those, being kind of a, them and AMD making the big video cards for gamers, graphics cards, that is, and then the crypto miners found out that the processing power in those video cards was what was needed most efficient for mining crypto. So then NVIDIA, that's what these explosions are here. And then, of course, the latest run up is the AI hype. I'm looking at a weekly chart, just so you know. So this was all crypto mining, and then Bitcoin crash, and then and anyways, now NVIDIA is considered the king of AI chips, and so that's the latest thrust up. But that's just a long-term chart right there. That's actually the one I have marked up, and it shows you the nature of this beast. It's just, semis tend to be much more volatile. Overall, the trends are just mind-blowing because their growth rates are very high. So when things are good, they're doing great. They're doing a lot better than the broad market, even the NASDAQ 100, even Apple and Microsoft. But when things go south, it's just the nature of this beast. The corrections are 90%, 86%, 56%, 69%. Remember, I highlighted recently, put this one as a short trade idea right here. And we swung it down. T2 was hit, time to cover. That was a 69% drop. Okay, had to pause it there for a phone call. All right, so quickly, this ties into the semiconductors, where they're going to go. Obviously, it is the undisputed king. I mean, NVIDIA literally has a $1.2 trillion market cap. The next largest is Taiwan Semi, at least in this sector, in this ETF, and I believe of all of them, at 513 billion. Then Broadcom at 401. 401 billion. So you can see it's more than twice the next largest semi by market cap. But you can see the charts, and this is a weekly chart you're looking at. So this is big picture stuff. If you're new to this, or if you've been following me for a while, it's very important to pay attention to what time frame I'm talking on and speaking to, what type of trades, holding periods, percentage gains. When you're trading on the weekly chart, you're looking at trades that are going to be measured in months or years, and they're going to be measured in double digits, sometimes high double digits on the gains, and things cut both ways too, but no one's going to be against a triple, quadruple, or 5-time gain or loss in the wrong position, in the wrong direction. Hopefully not. But you can see here, it's just simple. I have them all marked up here, the divergent highs. There was one there. I don't know. I missed the drop. It doesn't look like much when you go back from this far, but I'm going to just ballpark it here with the measuring tool. Pops up on the left. That's about a 53% drop right there off that little small divergent high. And so these work. They don't always work because sometimes the divergences get burned through. This is not even confirmed. It's not my ideal divergence. Typically, you want to see the PPO make a cross and then reverse again. But again, you already had divergence at that previous high right there. And the divergence now, we're making an equal high, if you zoom in real tight. So you technically have even larger negative divergence, because all you have to have is prices making an equal or higher high with the indicators making equal or lower highs. And you don't always have to have the perfect crossover and then roll back down. What I'm trying to say here is there are no sell signals. Divergences are not a sell signal. In a minute, I'm going to segue into the broad market, and we're going to look at a few more breadth indicators I haven't showed. Just like that, divergence in deteriorating market internals when the stock market is going up, but you see fewer and fewer stocks advancing and more declining. That's what we call negative, market internals. They're not sell signals either. They are merely an indication, the condition of, that something isn't right under the hood. And sometimes those conditions rectify themselves, and I'm going to speak to that in a minute when I get into that. And sometimes, and quite often, they play out for a trend reversal. So there's NVIDIA. I can't speak to how important this stock is, not just for the semiconductors, but I will go on record as saying I believe it's more important than any of the Mag 7, even though it doesn't carry the market cap weighting that Apple and Microsoft do. But so you can see it here on the daily chart. You can see, as I mentioned, it reports on Tuesday after the market closes. So as of this point, we have the equal highs. So we do have, as I covered it the other day, negative divergence. I will put very good odds that these divergences play out just from my read on the chart, looking at the stock, the hype in this stock, over-owned, over-loved, and my pullback targets are, look, I haven't changed my targets since before anybody knew the last bear market was going to be a bear market was underway. I laid those targets out when I put it on as a trade here, and I had and remain T3 as my next target. We hit T1, we hit T2. There were a lot of reasons to cover there, and this one and some others and go long. So that's the bounce, and this is the next drop, next target. We already hit T2, and so if it's hit, I measured it out here. Where is it? Here we go. If it's hit from roughly where we're at now, it's going to be about an 86% drop. So again, I know there's some out there right now say you are smoking something. NVIDIA, this is the bluest of blue chip semi, or the king of semi. This is AI thing's going to change the world, blah, blah, blah. I heard the same thing in the dot-com bubble. I'm, fortunately, or for lack of a better word, old enough to have been around through those and some other bubbles, and it's no different. Even back in 2007, there was no dot-com bubble, no tech bubble per se, but NVIDIA dropped 86%. And it came in to check its long-term uptrend line, which by the time we get there, remember, my price targets are not, they're not where I think it's going to fall in time, just where it's going to go in price. And that's one reason I'm not an options trader. I've certainly, had my share in the past. I've traded options many times, and I've learned that that's not my cup of tea, because as I often say, it is hard enough to call with precision where a stock is going to go, or the market, from point A to point B, whether it's a rally or a correction. It is infinitely harder. It brings in some magnitude of difficulty to not only call where it's going, but when it's going to get there. In other words, if that's my target and I think we're going there, hey, if this market kind of crashes soon in the next 6 months to a year, we can get there pretty darn quick like that. And that would be, by the end of next year right there. However, we may zigzag down, and it may be 2 years before we get down there. And if we get down there without going a lot farther, then I'm right. If we go a lot farther, then we get there. And in a minute, I don't have a position right now, so I'm not going to be wrong if I'm not in it. But that's something to watch. And again, so why do I think it's as, if not more important than Microsoft? Microsoft and Apple, because again, it is the poster child, the undisputed poster child of AI, the AI bubble, the AI hype. Those that believe it's going to have a tremendous impact. I certainly have an impact on the world. I just don't. I'm in the camp of some that it's going to take a long time to play out. And there's it's going to certainly change a lot of what we do, but I don't think it's going to cause these tech and semi stocks to go up another 1,000% in the next year or so. In fact, I think most of that's been priced in. Okay, so that's that big one. They report Tuesday. So where I'm going with this is that's probably why the market's just floundering around today. I'm going to get into some economic reports, but this is one of the things. And I am not making a bold prediction or anything. If you ask me again, if I had to bet it, and I may take it, probably an indirect bet. I don't think I'd trade it directly, but maybe just being short the NASDAQ going into earnings. If I had to bet it, I would say that the initial drop will be to the downside. But that's a to me, that's a unnecessary bet, because when you go long or short into earnings, and especially when you're going long or short the individual stock, you have no control. You cannot mitigate your losses. You can't control them. You can't cap them like you can with futures and other things. Why? Because this stock will instantly, in the after-hour session, when they report, it's going to rip up or down one way. And that might not even be the way that it ends up going afterwards. But the problem with trading stocks is that they're liquid from 9:30 to 4, and you can use stop loss orders. In the after-hour session, you cannot use stop loss orders. You can only use stop limit orders, and that says sell me if, let's say you decided to short it, but you wanted to have a stop limit order at $500, right? It's at $492 right now. And this thing just rips right through there. It may bypass that. You may even see a print at 500, but it doesn't mean that they have to fill you. It's just if your order wasn't in line, it's going to get bypassed, and this stock could shoot up.
Market data connection lost.
You don't have your order set to fill in the after-hour session. You just have regular sessions. This stock could gap up the next morning at 560, and your limit order stays there and will only be filled if the stock comes back down to 500. That's a stop limit. Or you use the stop loss order, which says if the stock exceeds $500, instantly trigger my order, and it then becomes a market order. And which means, remember, you can't have those in the after-hour session. So when the stock gaps up in the morning at 560, your order is in line with a gazillion other orders at 9:30 a.m. queued in there with order imbalances. They get filled there, and that just may be a blow-off spike, order imbalance, and the stock could do this. And guess what? You're stopped out with a huge loss at 560, even though you had your order there. So, okay, so enough on that. That's why it's just gambling to trade individual stocks. Futures, they'll trade around the clock, so they may rip and your order may not be filled, right where you wanted it, but it should be very, it's quick. It's quick. If you have the NASDAQ 100 futures, they're liquid, very liquid at, 6, 7 p.m., 4:30, especially when they report. Okay, and why I wouldn't lay a direct bet on the stock, long or short, for that reason, the reasons I just stated. I'm not a gambler. I take risks, but they're calculated risks, and I try to quantify or minimize my loss potential. as I often say, if a stock has a clearly bullish or bearish technical posture heading into earnings, that was my busy board. I'm just giving you a clean board. This is what I call busy board. I have tons of little key support and resistance levels. And remember, my big purple lines that I've been talking about on all the big Mag 7 stocks, none of which have been violated. In fact, NVIDIA only tested the first one. They've got to take out the final one, which is 375. That is a massive, massive level. So that's why I do these videos. Lots of talking, lots of jib jab. But at 375, oops, didn't mean to do that. I meant to go to a cleaner board here, which we'll do right now. And just clean so you can see everything. Why is that level important to me? Well, there's that gap. That gap, again, as I covered in yesterday's video, wasn't just significant to NVIDIA. It was just, and again, I was on vacation, but remember listening to the media and all the bobbleheads coming out. And it just kind of said, it was the defining moment where people just kind of just accepted, there seemed to be this just sudden acceptance that AI is just going to keep the tech stocks on a tear forever. And it's going to change the world, and they're going to just keep going up. And there was a massive gap up in NVIDIA. But again, I took the NASDAQ 100. Everything else had nothing to do with NVIDIA, including Apple, Amazon, Microsoft. They all ripped right up and followed this one. So that's kind of what I call the AI gap, whatever you want to call it. And if that gap is, well, first off, we enter it, you can see from above any chart. When you look at gaps, traders love gaps. They're very technically significant, and the bigger they are, the more obvious they are. Again, it'd be hard for anybody to miss that gap. And the way it typically works is once you enter a gap, normally then you're going to backfill it. So there's the top of the gap at about 374. There's the bottom of the gap. However, in this case, you have just a confluence of key supports. In addition to that, you have the primary uptrend line off the October lows. Right, that was a big divergent low, right there, and that set the start of this uptrend. The divergences were one of the technical catalysts for it, and so you'll take out the trend line. And then you can see here the 200-day moving averages, the blue and red lines right here. When an uptrend, which we were right here, you're above the 200s. When you break the 200s, as you did right here, you're in a downtrend or a bear market. You run back, got rejected. Finally, this is where we took them out, and you've remained above the 200s. So again, if we take out 375, and I'm not talking a little brief pop there and then reverse the next day or two, a solid move back down below there. Especially if we go to backfill the gap, you're going to be well below the 200s. So guys, I'm not predicting that's going to happen, but I'm certainly saying it could happen. And all I'm saying, if it does happen, be aware of it, because it's not just going to impact NVIDIA, in my opinion. It will impact the entire tech sector. It will impact the entire semiconductor sector, I should say, and the tech sector, and pretty much the stock market for many reasons. So there it is. So those are the levels to watch, and a stock to watch. And then again, if I had to go long or short right now, throw away the key for 6 months, short all day long. I can easily see it pop up here. If it did, it would just move these divergence lines. I mean, this stock would have to really, really rip to take out these divergences. In other words, bring the PPO up and the RSI back above these other lines here. And it's certainly a possibility. So now, 28 minutes. Okay, now let me kind of segue into the stock market. This is one big thing to watch. The other things to watch, of course, are, there's a lot, but economic reports. I'll get to those in a second, the latest ones. And now let me do this. Let me go back to bonds, and then I'll get into stocks. Okay, so I am going to do what I have done in little bits and pieces, but I've got it here concisely for you, the bullish case, which means that maybe we are in a bull market. Maybe this was a bull market that started, no, more in TNX, back last year in the October lows in the S&P 500 and the NASDAQ. In other words, that all the indexes, not just the NASDAQ, the S&P, they're all going to new highs, all-time highs. They're all taking out their 2021 and 2022 highs. That would be the bullish case, okay? Or another way to spin it, another 20, 30+% upside in the market before we have another bear market. Okay, I'm making the case for that. The case would be number one, and probably to me the most important, is this market just went through one hell of a stress test. You probably heard back, after the financial crisis, the Fed started engineering and conducting stress tests. They ran a few on a couple different times on the banking sector. In the stress tests, they run scenarios to see, what would it take, if this happened and that happened. Do the banks have enough capital to stay liquid and not fail? And that's what a stress test is. Others of you, especially when you start getting up there around my age, you probably know what a stress test is from your doctor or your cardiologist. They put you on a treadmill. They have you run till you can't run anymore. They push you to your limits. They go, go, go until you cry, "Uncle, we're not going to stop the test." That's how my last stress test was until you tell them you can't do anymore. They keep raising the incline and the speed of the treadmill. And so what they're doing, they're pushing your heart past your well past your target heart rate, even past your maximum heart rate. If you can't, if you can push that far. And then they're running all kinds of tests to see how the old ticker is, if things are going to break. And now I imagine some people, I have to say, I imagine it's probably been a decent number that were scheduled for, probably had a heart attack right there on the treadmill. And I imagine other people, I talked about this before, there's stories of healthy people working out at the gym. Some people die while they're working out, or athletes on the field, but then quite often people after a workout, they come home and that's when a heart attack happens. So we're not out of the woods on the stress test. However, we did hit, as I was using the analogy recently, the tachometer, in my opinion, was pinned to the red line on the market with yields where they were. And the fact that nothing broke right now with yields abating is that the market, to me, just passed the ultimate stress test, something that the Fed, nobody else could engineer. It went through it in real time, not some hypothetical model, and nothing broke. Again, that doesn't mean, in fact, I still think something will break. That's maybe the negative, pessimist in me. These higher yields will, if not now, there's still a lot of debt, a lot of companies' debt rolling over that hasn't yet rolled. However, if nothing broke there, and the banks didn't break, we didn't see any other failures there. Of course, the Fed's still backstopping the regionals and not whatnot, but we saw, the big banks get, really run down pretty hard. But everything now is doing a lot better, especially those rate sensitive sectors like financials and REITs and other things. And so we've come off the highs. And so here's the potential bullish case that the stress test had happened, nothing broke. And so now if they didn't break here and rates continue to fall and this plays out, remember, I've set up what I called the most bullish setup that I've seen in bonds in a long, long time, since before COVID. And that is, this is the yield of the 10-year, which is opposite to bond prices. Big, big negative divergence, your primary bull market uptrend line, and it's now been broken. I am being a little skeptical. I'm still holding, I told you, long-term accounts. That was it. I went in heavy right here at the highs. Got, hopefully some of you, I think, heard back, some of you got into. And that's also in those accounts. I'll be in and out of shorts. If I am, they'll continue to be hedges. I'm not pulling the plug until I see this fail. And this is where I'm going, guys. So far, we're just below the uptrend line on the 10-year. I'm going to get to the 30 in a second because we're not. We're right there. This was also a very significant level right here. This was the previous all-time high. And this was what did it to the markets. That the big correction we just had that we finished a couple weeks ago was due to this. This was a breakout. We hit that previous high. Boom, boom, boom. Remember that TNX, when you're looking at the yield, just move the decimal. That's 4.358%, right, that line. So when the 10-year popped it, and again, it was multiple reactions, that took us to new multi-year highs. That rocked the stock market. We had the biggest correction all year. And now we've come down. And again, as on face value, this breakdown here is bullish as long as it sticks. However, we're not out of the woods yet. You still have, if you turn off all my trend lines, right, and just draw one here from those highs, then what you have is a breakout and maybe the first back test. Okay, so keep an eye on things. That could very well happen. And remember, TNX, the inverse of that, the bond itself, if you're just going to use ETFs, you can use Treasury bond futures. Right here is IEF. This is, I'm jumping between time frames. This is a daily chart. So it's broken out too. And again, it came off a big divergent low, multiple breakouts, breaking above this trend line, but it also has resistance. There's those previous, remember that was the previous highs and yields right there, which were the previous lows. So this one's back testing. So we're not out of the woods yet. And I think from the look of this rally, the market has 1,000% priced in that's it. And I've heard a lot. Look, guys, not just one. Every pundit that I've heard march out, every article in writing, print, video, people on TV have declared the Fed's done. Interest rates are only going lower from here. And, they're mainly talking about what the Fed's doing, but my God, if this happens, meaning bonds take another leg down and they take out these highs, this is what I'm telling you. It's not a prediction, but it's a to watch for, because this would be the lights out moment for the market. I'm talking a kind where I would load up as much as I could buy in shorts, and might even go with some options at that point. If we were to turn around soon, just a breakout there, because that would just catch so many off guard, because the vast consensus is that's it. Rates are done. And again, look, there's a bullish case, and don't get me wrong. I'm long bonds right now. Like I said, I'm a big chunk in long-term funds, because it is bullish. It's bullish unless it fails. Like I said, I'm recognizing this is TNX, the 10-year. There's our near-term uptrend line right here. That's the daily chart. Here's my weekly chart on TNX. See, when I draw it on the weekly, TYX, excuse me, guys, TYX, that's the 30-year. When I draw it on the weekly, I have a trend line. It's crazy. Trend lines just drift. I had just updated this one today. Let me go to this board. And I had it like this. Anyways, you can go. Oh no, it was another security. I thought it came in at that low. No, this is the way I like my trend line on TYX, a 30-year yield, because it's clean off that December low right there. Come in. So if you draw it this way, you're still above trend. If you want to come off the COVID lows and come in there, you're still well above trend. Again, you've heard me say it. The 10-year is more significant, I believe, than the 30-year, but the 30-year is important, and that one is at trend right there, right? You can see now, just like TNX, it has big negative divergence, but it's also just like TNX. There's that big high back there from this one, the stock market bottom. That's the October low in the stock market. That was so far the bottom for the rally that's still in play off of mid-October of 2022. That's when yields peaked, so there's no coincidence that's when the stock market rallied. But then we went up recently, and we took that out. So this was the breakout right here. Remember, this is what roiled the markets recently. And so we're coming in for a back test of that. So again, I can make a bullish case as I have for bonds, because this is a bearish rising wedge pattern complete with negative divergences. It looks like it's going to break down, and there's going to be quite a drop in yields, and that should be net bullish for the stock market unless anything blows up. And the only reason we're seeing yields fall is a flight to safety. And then finally TLT. So I know I'm covering a lot here. TLT, this is a weekly chart. There's the trend line I have. And it's a big bullish falling wedge, but we're still below it. And we're also, when you look at the trend lines I have here on TLT, I have this uptrend line, which we're still below. There's that previous low right there in TLT, which matched with that previous high in the yield, the 30-year yield. So the 30-year hasn't yet broken out. It's set up bullish, but it has not broken out. And the 30 and the 10-year bonds have yet to, again, take out those key previous reactions from right here and here. So we're not out of the woods yet. And the thing is, if that gets rejected and TLT runs down, takes out the lows, that's because the yields have now broken out to new multi-year highs. And I believe the market will be crushed at that point. If that happens, even if we get anywhere close to there, I think the stock market will be in free fall. That's my opinion. And that's kind of your get in. So I made the bullish case. And that so far is, what we had. Just because we haven't broken out, I can't get over. I'm just watching these levels, and I want to see that. If this happens, that's going to add to the bullish case, which again is interest rates have peaked and they're going to come down. And the other factors, I told you I would kind of wrap all three together. So falling interest rates, which we currently have recently, right? That's why bonds are rallying and the stock market is rallying. And the outlook that looks like we're going to have rates continue to fall, at least for a while. That's bullish. When I look at, which I'm going to do here in a second, I know this video is getting a little long, but I'm going to compare the top tier of the NASDAQ 100 to the bottom tier. And I've been doing this a lot lately. When I look at the beat down stuff, because that's why we have that I'm going to show you in a minute, additional breadth indicators that show you that it's not only, but mainly a handful of big mega tech stocks that are doing all the heavy lifting still. However, those bottom tier that have been lagging and are not anywhere near their highs, there are actually a lot of divergent lows and a lot of bullish wedge setups and other type of inverse head and shoulders, some other potential bullish patterns. They haven't played out yet, but they're setting up. So where I'm going with that is check mark number 2 for the bullish case. Again, I'm just building the if it continues to develop. If we see the second and third tier, the secondary and tertiary stocks in the NASDAQ 100 and the S&P 500 even, NASDAQ composite, start to catch up and some of these bullish setups start to play out and they start to outperform the big tech stocks, that would be healthy for the market. So that's something to watch going forward. And let's get into that now. Let's get into the charts of the breadth indicators, that is. Okay, I'll cover this one quick because I just updated yesterday. This is the NASDAQ 100 up top here, right? And this is the NASDAQ advancing and versus declining issues line, an indicator of use for many years. You can see that's the bear market in 2007 to 2009, 50-something% drop. I have log scaling here, so it doesn't look like much, but it is. All the big drops. Again, I covered it recently, and it's just a dang reliable indicator. When you get these negative divergences just like here, that's why I was looking for a bear market, a big drop with big aggressive targets on things like Nvidia and Amazon and Apple and all that. And that's what we got. And that was foreshadowed by clear negative divergence between the NASDAQ 100, again, and the number of stocks that were advancing versus declining. So that shows you there's evidence there that it was largely the Magnificent Seven and a lot of the big stocks going up while the market was going up, but yet the majority of stocks were falling. That's again, negative sign. Another way to look at breadth, internals, this is what most people see. This is what you go to a cocktail party or talk to your neighbor's friend. They only look at the stock market and they're bullish when it's going up because it looks well, and why are you all bearish? It's like going to your doctor. You can be fit, you can run, jog. You go see your doctor. He gives you your annual physical. Your body fat's low. You're not overweight. He checks your heart. No murmurs. Everything sounds good. You look great, right? That's the stock market. But then your blood work comes back. Ooh, we got a problem here. So that's what this is. This is like when you dive into the markets and you look at things with technical analysis, like the internals. That's what it's like, sending in your labs. And things are being studied under a microscope and saying, you know what, hey, things look good on face value, like this market. A couple comments yesterday. We had one good up day, and a couple comments from subscribers. We're in a new bull market. Certainly looks like it, feels like it, but the number of stocks in the NASDAQ that are advancing versus declining is telling a different story, a completely different story. So it's the same story all year, and it's gotten pretty pronounced lately. It's just a handful of stocks. They're beloved. They're earnings juggernauts. They all have massive stock buyback programs, so obviously that comes into play as well, where a lot of smaller companies, they don't have the cash flow, and Apple and all those companies have, and so they're not able to game their stock by buying it back every time there's a dip. Okay, so that's one indicator. I already showed it to you. Let me show you a couple more. Okay, here's another one I've been using for a long time. Really like it. Again, there's a lot out there. Just want to show you 3 today. I showed you one. Here's another one. This is the NAHL. That is the NASDAQ New Highs versus New Lows Index. As simple as it sounds. How many stocks? And by the way, if you guys aren't familiar, when I say the NASDAQ, if I don't say the NDX or NASDAQ 100, it's the NASDAQ Composite. What the NASDAQ Composite is, it's all the stocks, every single one, both domestic and international, that trade on the NASDAQ stock exchange. So that's the NASDAQ, and it's well represented. I think there's, it's over 2,500. So it's very diversified. You got a lot of stocks in there. And most of the indicators are going to give you that. They're going to not work off the NASDAQ 100. And again, these indicators have worked for a long time. Sometimes I'll plot them against the NASDAQ Composite, which I'm doing here, or sometimes I'll use it against the NASDAQ 100 like I did just on the previous chart. However, the simple part is the trend. Now, the NASDAQ 100 and NASDAQ Composite are always going in the same direction. Just sometimes one is, if there's what we've seen lately, the outperformance due to the overweighted FANGs, the NASDAQ 100 more concentrated. It's been doing better because of that. Again, that's a bad sign for the market. That's showing everything's not well under the hood despite the rally. And this one, you can see I do have divergence lines, but forget about all that. This is the divergence you want to look at. That's not a MACD. It's a custom indicator I created. On stock charts, I use the MACD to come up with a histogram, and this is it. So a histogram, when it crosses the 0 line above, it's bullish. That's where you have all these hills. It's been a great indicator, guys. There's been 2 whipsaws since this bear market started. This is where it signaled. See this big green, this big green hill where you were above the 0 line? It said bull market. Be long and strong. This was COVID right here. This indicator said, call it a 401k indicator if you want. It said it's a bull market. Get in, stay in until it flips. Now, again, I use it in conjunction with other things because there are little whipsaws here and there. But for the most part, that's what the histogram tells. When you look at the 2 lines, what it is, I didn't even tell you. I put up a 20-period EMA, exponential moving average, over the NAHL. And when that 20-period EMA is above it, that's when the histogram is, above it, the histogram is above, then you're bullish right there. And so it's a very good trend indicator. It doesn't have a lot of signals. And you can see it flipped. It said sell, bearish. We're in a bear market, a bear trend right there. And other than these 2 little whipsaws right here and here, I'm sorry I can't make this any bigger. I probably can. Other than those 2 little whipsaws right there. There you go. There and there. It said we're in a bear market. The trend is bearish. And again, you can, freeze the video, take a look. If I sit there and go back at every all of them, it will take forever. But you can see the big trends. And again, when you see it's a bull trend here, and you can see I have lines marked, that was one of the strongest unidirectional bull trends in the market right there. All the corrections we've had, all the bear markets, there's the bear market, the last real bear market, October of 07 to March of 09. And it told you with 0 whipsaws, get out, stay short, get out of your longs, or short and stay short to right there. So it's a heck of an indicator, and I just want to share it with you. And again, it's a it's a trend indicator that I use, and I have one more for you. Yeah, I love this one as well, and it's something I've shared with you guys, but not for a while, in the past many times, and use it for years. Simple, effective. Most of you have heard about moving averages, even if you're new to this. And if you're not, become familiar with them. And the big ones are the 200-day, the 50-day. Those are 2 of the most popular right there. And this particular charting platform has these 2 indicators. They don't have for every moving average, but they fortunately have it for, you can do it with the S&P, or in this case, the NASDAQ. And that is down here. You can't see my writing. It says percentage of stocks trading above their 50-day moving average. And down here is the percentage of stocks trading above their 200-day moving average. Okay, so both on the NASDAQ. Up here you have QQQ on top, so you can see the trends. And then what I did is on this chart, if you want to replicate it, when you throw those indicators up below, click that advanced settings tab or additional, and add a horizontal line and put it at 50. Why do I put horizontal lines at 50? Well, it's very simple. It's a range bound indicator. What's the maximum percentage of stocks that could ever be trading above or below their moving day one average, any moving average? 0 or 100. You can either have every single stock, which you're never going to have, trading above their 50-day, or every single stock trading below their 50-day. And so 50 is at kind of that point where half the stocks in the NASDAQ, when they cross this line or when they're at this line, half the stocks are trading above their 50, half are below it, right? Pretty simple stuff. That's why I put that line there. And as that common sense would dictate, especially the 50 is going to move faster, but if you look down here, focus on the 200. And what do you see? So, you're going back here. I'll only roll this chart back. You can replicate it, go back as far as you want, but you can see the corrections that you have here. And there's some pretty good ones, 23%. There's COVID, 31%. There's the bear market we just had, or, I think initial leg down, a bigger bear market, but about 37%, right? And what you see here, it's pretty clear. And it makes sense that when you're in a bear market, the majority of stocks are trading below their 50-day moving average, right? COVID, they were below it. Fourth quarter drop of 2018, we crossed down. And it's also usually when the bear markets start, sometimes it comes a little early. And it's a breadth indicator. Where I use this, you can see my line. So the fact we're below it, this just right here, and this speaks to the breadth thing. When some of the folks said yesterday, see what breadth thrust, we're in a new bull market. The market's not in a bull market. Amazon, Microsoft, Apple, NVIDIA, the Magnificent Seven, they're in their own little bull market. The rest of the world isn't. And, again, that's not my opinion. It's not a subjective call. It's a factual call, because right now in the NASDAQ composite, only 44% of only 44% of the stocks are trading above their 50-day moving average. That means 64% of them are trading below it. And when you look at the more significant, which is a better longer-term trend indicator, only 30% of the stocks in the NASDAQ are trading above their 200-day moving averages, which means 70% are below. So therefore, by this metric, and that's why I do these long-winded videos. People are, Randy, how are you saying so bearish? That's, and you start flipping these indicators. And again, this is something I'm going to watch for. If I start to see participation, the video is getting long enough. I'm gonna end it where I wanted to, because I did want to show you just that what I talked about earlier, in what would change my view, what would make me start to look for more buying pullbacks to support to go long, or breakouts above resistance, instead of looking to position short on breakdowns below support or rallies back into resistance. Does that make sense? When you're in bull mode, that's what you do. Buy pullbacks to support, or wait for breakouts above resistance. And when you're bear, it's the opposite. Short rallies into resistance, or short breakdowns below support. So let's do this, and we will wrap the video up. This is the NASDAQ 100. I'll keep it on a weekly for right now. These are the top components right here. Apple. I have different boards. I'll just leave this in my busy board. Flirting with, not yet, but getting close to new all-time highs. Certainly much closer to all-time highs than, or 52-week highs than the lows, right? So very bullish chart. Microsoft, all-time highs, right? This is again a weekly chart. That's just targets I laid out back here when we first, before the bear market started. We hit my first target and we bounced, just like NVIDIA, and then we go down to my next target. So where I think we're going. We had divergence there. We have the only difference now, we have the same divergence. It's only much bigger, indicating a much bigger drop, in my opinion. Anyways, so this one, bull market. You can't argue that, This Alphabet, still off its highs, but, a lot closer to all-time highs than its multi-year lows, right? Amazon, a lot closer now, or a little halfway point, a little more than that, to its all-time highs. But certainly, doing well lately. NVIDIA, obviously, right? Meta, and then Tesla. Look at that big divergence building on Meta now. And then Tesla. Those are your Mag 7 right there, guys, right? Okay, so looking pretty good overall. And now what I'm going to do, the reason that what I was doing is clicking through the component list of the NASDAQ 100 companies in there. I just showed you the top 7 descending by market cap. So I started with Apple. It's a $2.9 trillion company. Microsoft's $2.8 trillion, and so forth and so on. Now I'm going to flip that list. You can't see it. Well, I'll show it to you. You can see it this way. Flip it now and go to the bottom tier of the NASDAQ 100. So you have Lucid, Enphase, Illumina, Illumina, Allergen, Walgreens, Zoom, Siri, eBay, Warner Brothers, and Dollar Tree. Those are your bottom 10. So let's look at those charts. Lucid hasn't been around a while, so I'm going to show you a daily chart. I'm going to move things back here. We don't need to see that list. Just put it back here and show you what I was talking about. So these guys, again, this is representative of the rest of the stock market. Now, yes, I'm using an extreme. I went to the bottom. But remember, I went to the bottom 100 of the NASDAQ 100, not the NASDAQ composite. The NASDAQ 100 is the 100 largest companies in the NASDAQ. They're domestic, and they're the largest companies out there. So these are all, again, multi-billion dollar. These are large caps, guys. These aren't small cap, little penny stocks or anything like that. So Lucid, beautiful bullish falling wedge. Had the divergent low there, and you had a nice pop. When you get short interest high, these things rally. That was 62%. This thing breaks out. The measured target for that wedge is huge. I could see this thing easily mounting 100% plus gain. And so. But the thing is, it's in the downtrend. The trend is bearish. The chart is a bullish setup. And if that starts to play out, and not just Lucid, but you have Enphase, Energy, this one not as much. See, and this is what I talk about too. In bear markets, they're like bull markets in reverse. Bull markets just roast short sellers. They just tease you with these beautiful little bearish setups. Believe me, I've had my share of them to take them. And they just don't play out. The dip buyers keep coming in. A bull market's a bear market in reverse, where the sellers just keep coming in. Every time a stock starts to look like it's going to rally, starts to get set up, and beautiful little setups like this bullish divergence this thing had, and it started to go there. You probably had you didn't have a trend line there. But they sold into it right off that. And now you can see they have taken out the divergence. See that? Now you have lower lows in the PPO and RSI, so you don't have the divergence anymore. Doesn't mean the stock can't go up. It just means that it's not there anymore. But also you can see this stock is down off the high 78%. I didn't measure Lucid for you off the high right here. Let's just do the December 21 highs, down 93%. Okay, so this is, in Seinfeld, remember George's fan, George Costanza, he would do Festivus for the rest of us. That was his, holiday for those that don't celebrate Christmas or Hanukkah or whatever. Well, this is the bear market for the rest of us. This is the world you don't see when you look at the S&P 500 and the NASDAQ. Or turn on CNBC. They talk about the NASDAQ was up this much. This is the rest of the stock market right now. Illumina is down 83%. With no signs of a bottom. I mean, we have a little RSI divergence. This chart looks like crap. And this is a bear market. And this is where most stocks are right now, as I just showed you. Not necessarily at 52-week lows, but there's a lot of them. And most of them, as I showed you a minute ago, are below their 50 and 200-day moving averages. Align, that's Align Tech. I said Align Tech. That one had a bearish rising wedge right here. Oops. Played out. Look at that breakdown. Boom. I must have highlighted that as a trade idea. I would have had, that's my measured target. I would have covered this one at some point, and it more than exceeded that. That's also this nature of signature of a bear market, when you have a beautiful bearish chart pattern and it plays out to at least or more than the extent of the measured target of the pattern. So that was bear divergent high 1, correction 1, ended with a big bullish falling wedge. That could have and should have, in a bull market, that bullish falling wedge with positive divergence should have took this stock to new highs. But guess what it did? It's just wave 1 down in a bear market, wave 2 up. and we've now started primary 3. Now we still have that low to take out, but if we're going to have a major 5 way down, this is going to be the wave 3 is always the biggest. Walgreens Boots Alliance, nice positive divergence, but again, this is my point. This is why I do these long-winded videos. Beautiful positive divergence right here, right? This stock had every technical setup, every reason to take the ball and run, but it's just been riding its 200-day moving averages down, right? That's what stocks do in a bear market. They're below the 200, and they get rejected. Why didn't Apple and Amazon? Why were they able to take them back? Well, again, they're different companies. They are cash cows. They are unique in their position. Obviously, we all know that. That's why they're in the elite $1 trillion club. And they also have a crap load of cash that they've been using to buy their shares back. And that works until it doesn't work. And believe me, there were share buybacks in the last bear market in 2008. And I heard the same thing, that they're going to go up forever for these reasons. But that's it, guys. I just wanted to show you. So some of these are setting up nice. That doesn't guarantee they're going to go up. But I'll watch that. And when does it start to change? Well, when you start to take out, trend lines, that trend line, then that one, then you're also going to take out the 200 days, and not just Walgreens, but collectively, you want to see them all go. There's Zoom. Look at that, another divergent low. I pointed this out as a trade idea back here, and we had a couple. We hit off that divergent low, rallied, but look, they sold into it. Another divergent low, pop, they sold into it. Another divergent low. Maybe one of these divergent lows will stick, but that the bear market's in full swing if and when the majority of these bullish divergences are just taken out, meaning we haven't had a meltdown. We didn't even have a meltdown last year when the market bottomed. It's been orderly, and that's another signature that the bear market's not over, only that we're in the end, towards the end of a bear market rally, because we haven't seen that typical capitulation. There's Siri. Chart looks like a mess. eBay and Warner Brothers. I told you I'd go over the top 10. See, there was a divergent low, rallied, but put in a little divergent high, and it's moved back down now. Trying to put in another divergent low, but again, that's just a bear market kind of signature. So if they start to play out, this is what I'm watching. I may not cover these every day. I may not cover these stocks for another 3 months, 6 months, or at all, unless they look good. It is something I monitor, and again, you can do it a lot easier looking at those breadth indicators I showed you. Percentage of stocks above their 200-day moving averages, advanced decline ratios. You can look at it in the S&P 500, individual sectors. But as of now, like I said, it's really a bifurcated market with the big tech still given the false guise of a much stronger stock market than it really is. We're over the 1 hour mark. I was going to go over there's no reason that the economic numbers. Heck, I might as well. I already did an hour. They came in today above expectations. Remember, I told you I'm watching jobless claims closely, and the range was 201 to 225 with a consensus of 222. So that ticked up. Remember, I've showed you before. The video's gone too long. I'm not going to pull a chart. We are trending up for the last 6 months or so. We're making a series of higher highs, higher lows. This isn't a higher high. We need to take out, I told you, I think it's 250 on the initial claims. But continuing claims remain hot as well. The other indicator, the economic report today out, was industrial production. This is how, this is also a tell on the economy. Consensus was for a drop of 0.3% month over month. We doubled that, low end of the consensus range there. So those are two reports today that are both should be net bearish, or certainly net bearish on the economy. Now, look, they're come out every month. It's not a huge miss. It's low end of the range, but it's something worth noting. Manufacturing output consensus was a drop of 0.3, drop 0.07, well below expectations. So that's it. And now the market and bonds were actually up today because of that. So we're entering that little bizarre world phase where the market's starting to welcome softer numbers to kind of solidify the Fed, that the Fed is finished, and that we're going to see the next move they're going to make us to a cut. Be careful what you wish for. I promise you, fundamentals ultimately will play out. I can't promise the economy is going to turn, go into a hard recession, or anything like that. I can tell you that it's trending, that it's rolling over, starting to see some early indications, some trends emerge, and I'll continue to monitor that. And there'll be that flashpoint where one of them is going to come in, and there's just maybe it's just a regular, even a consensus hit on one of these economic reports, and at that point, if it's the flashpoint where the consensus realizes, oh shit, you know what? We're focusing on the Fed, hoping for another rate cut, but we're going to get that rate cut, and it's going to be because the economy's had the Fed's trying to prevent us from going into recession, or the recession's already here, and they're cutting rates now to pull us out of that. And then you see earnings really turn on a dime. Expectations are still very high. Everyone's betting on that soft to no landing scenario, and so continue to watch this. I'm going to wrap it up here, and like I said, long video, but watch those breadth indicators. You can watch the lower tier stocks, watch the various sectors, and like I said, I can make a decent bullish case. And if the data continues or starts to move that way, and particularly interest rates, that's the big one, then I might gradually or maybe more rapidly shift my map, that is, where I think things are going. But as of now, there's a lot of, especially the economic data, pointing to the slowdown, and probably coming sooner than most expect. But I'm going to wrap it up here and get the video out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.